Hello, welcome back to WinFS Trading YouTube channel, the only channel that has been optimized to make you rich trading the Forex synthetic market. Okay, it's been a long time. I upload content more than 1 minute. Okay, and each time I upload content more than 1 minute, it is actually made for a specific solution for a problem that many traders has been facing. Okay, it doesn't mean the 1 minute or less than 1 minute video doesn't carry on powerful information. They carry on powerful information, but when the video is more than 1 minute, I'm actually trying to address major problems, trying to bring out the solution. Okay, so make sure you stay to the end of this video. Make sure you like this video and you share it to your network, and don't watch first minute or watch it towards the middle and give up. No, watch to the end of the video. Don't just watch first 1 minute. Watch throughout the whole video over and over again. Rewatch the video so that you gain value from the video. Okay, so this idea is very, very important. So the topic is 3D Forex synthetic trading concept. 3D Forex synthetic trading concept. Okay, I'm going to read out the document and I'm going to go to trading charts to give you some practical, and then the video will be ended. So in 3D trading, a trader must run 3 categories of analysis. Number 1, raw price action analysis. Number 2, indicator analysis. Number 3, risk management analysis. Okay, why price action analysis, if properly performed, provides the most accurate direction of the market. The indicator analysis will never provide a signal. All signals from indicators analysis are error and loss driven signals. The indicators are control tools on technical analysis. They help one to follow trends rather than to trade against trends. It also helps traders to avoid ranging markets. To avoid confusion that comes from indicators, try to always run indicator analysis on different computers or devices. Okay? Coming to risk management analysis, it helps us to accept or reject entry or exit prices. It helps us to reject or accept entry or exit prices. It helps us to know the entry price, take profit price, stop loss price. From this, we can compute the risk reward ratio and make a good judgment on it. The risk reward RR of 1:3 plus is good, but if you have 90 to 95% win rate over a given period of time, then you can take RR of 1:2 plus. The higher the RR or your RR, the more you recover in event of losses. Okay, let me correct this. This is in event of losses. Okay, because you could have more than one loss after some trading. It is a failure to risk 100% of your equity per trading session. Okay, the reason is because despite how accurate your signals or strategy is, your trade is bound to lose due to other factors you cannot remember to put into consideration during analysis. Most times it could be market manipulations or fundamental news releases. Okay, practically traders are advised to risk 10 to 20% of their equity per trading session. This risk percentage helps you to compute loss size. Okay, if you want to get the formula to compute loss size, is available in my MT5 MT4 Forex trading course. So this is premium. This way you have to lose in 10 to 5 trading sessions respectively for you to blow your account. Okay, the following example shows the power of RR of 1:2 plus to 1:3 plus to 1:infinity, depending on what market gives and what you want or what your trading plans or goals are. Let us assume that WinFS has $S in his trading account. He got a 3D signal with minimum RR equals to 1:small r or lowercase r, where R is greater than or equal to 2. Okay, let us assume definitely or exactly that R is equals to 2. Let us also assume that you risk Y% where Y is greater or equal to 10% per trading session, and you cannot lose Z trade in a row where Z is greater than or equal to 3. Now Z is a kind of abstract radius, you know, because most things we discuss in trading the abstract, but when you apply them, you see they help you progress, in making much more profit and steady, being steady or consistent in account growth. So this Z actually represents a kind of radius. It is called the radius of recovery. Like, it's the number of trading session that you have to set, like you have to adjust, or you should have known like how many trading sessions that will help you to recover your money in event of a loss. Okay, so when I set it to 3, I have assumed that you cannot lose all your trades in 3 rows. Like, you cannot lose in 3 rows. If you lose in trading session 1, you cannot lose in trading session 2, or if you lose in trading session 1 and 2, then you cannot lose in trading session 1. Once your strategy is good, there's no way you can lose 3 trades in a row. Okay, so you can set your Z to 4, you can set your Z to 5. The bigger the value of Z, okay, the lower the possible number of trading sessions, like your universal, like your maximum number of trading sessions or total number of trading sessions available for you to grow your account. Okay, because this is like a kind of a round. Maybe trade 1, trade 2, trade 3 form one round, or trade 1, trade 2, trade 3, trade 4 form one round. The aim is to make sure that at the end of a round, you recover all your losses and you make profits, and you repeat the process. So that is what is the meaning of Z. That is why we call it radius. Okay, just like in automobile industry, there are different wheel of different radar. Some have small radius, some have big medium radius, some have bigger one, like some have a large radius. Okay, so those with lower radius have high speed. Okay, while those with medium radius have a little bit high speed or medium speed, and those with bigger radius have a low speed. Okay, now in the same way in trading, if the Z is minimized or approaches 0, you suddenly see your equity grow with speed of light. But the problem is, with your strategy protected, likely when you allow Z to approach 0, then your risk level, you are risking 100% of your equity. Now the question is, are you the market maker? Do you know the event in the market before it happens? You can know the event in the market before it happens under probabilistic spectrum. Under probability spectrum, like, is a probability distribution event. Like, you can have certain range of probabilities for which you can succeed, meaning that sometimes you might have drawdown or your stop loss is hit, while sometimes your take profit will be hit. Okay, because of unknown event, not that you don't know what you're doing. So there are things beyond you that happen in market that you cannot be able to control. All you need to do is to have a good psychology, and once you place a trade, you must be comfortable with trade before you place the trade. You have to have high utility before you place a trade. I'm going to talk about utility further. Okay, so what I'm trying to say is, if you let Z approach 0 faster, or even 1, if you let it approach 1 and 0, then you're actually trying to approach your risk level per trade to 100%. you'll be growing your account equity fast, or you blow your account fast. So because we cannot control the market, only the market maker can decide where market moves or where it shouldn't move. Then what you need to do is to increase the value of Z. The value of Z determines the number of trade in a round, okay? The number of trading sessions for which you can recover in the event of a loss, okay? So by the time you go through these documents, you will get to understand what I'm saying. So during trading session 1, there is a loss. The remaining capital, this is the formula to calculate the remaining capital. RC subscript 1. The RC means remaining capital or equity. So RC subscript 1 as a function of risk, percentage risk, is equals to the RC subscript 0. That is the initial, before you, like when you have not traded, the balance you have, the deposit you made. So it is RC subscript 0 minus Y% upon RC subscript 0, which will give you S bracket open 1 minus 0.01 Y bracket closes. Y is the risk. This time around, the percentage, you can't put the percentage because we have already added it. So it is just the numerical part of the risk. Okay. So, but if I remove 0.01, then you have to put the percent so that you use it during calculation. Okay. Trading session 2 is also a loss. Then the remaining capital, this is the formula you are going to use to calculate it. Okay, when you simplify, you will get this general equation. You don't need to cram this, just understand this from the fundamental. The fundamental equation is this: RC subscript N, that is RC at nth trading session, is equals to RC of previous trading session minus Y% upon RC of the same previous trading session. Okay. Example: assume that S is $100, Z is 3 equals to, and that is the discrete value of this set, equals to N equals to 1, 2, 3. Let Y be equal to 10%, and let R be 2 plus, that is 1 is to 2 plus. Perform the loss recovery analysis and draw conclusion. Okay. Now I say I'm going to touch utility. Some people, when they place trade, let's say for Forex, you traded GBP USD. At the same time, you will see some trader, they will also trade Euro USD. On the same trading session, they will also trade USD card. That is not trading. It is trying to show that you are not sure of what you are doing. Had it been you are trying to hedge, you are doing hedge hedge fund management, like we are doing hedging strategy. When I say hedging strategy, like when you divide your equity, like your total equity, you divide it into 2 or more, and trade them on different company, on different brokers, or on different assets, with certainty that you are sure that in the event of some of the trade lost, in the event that some of the trade are lost, anyone that win, any of the trade that hit your targets is going to recover those losses, or at least recover your starting capital, your overall capital. Okay, that is hedging. But what some traders are doing is different from hedging, because we are using the same equity. There is no idealistic, or there is no practical, there is no proper money allocation, because most time it will be like on a different computer or different devices, and then different brokers, and then different security. Okay, but this one, you are doing it on the same phone or laptop or desktop, and then you're actually trading the same type of security, which is Forex. this time, in this, when I talk about hedging, a hedge fund manager will actually allocate, like divide the total equity and allocate some. He can allocate some to stock, he can allocate some to Forex, then he can allocate some to equity market or bond market, government bond, okay? Or he can allocate some to agriculture, like he can divide the money and invest some in agriculture. That is hedging. If something happen in Forex or something happen in equity, government bond, then the agriculture investment will recover those ones. Okay, there are many ways you can think about hedging, but that is not what some traders are doing. They're actually doing what I call poor utility trading. What is utility? Utility is your ability to see one asset or one security and have satisfaction to the extent that you can be able to risk 100% of your equity. Remember, I say you should not risk 100% of your equity, but I'm trying to tell you what utility is. In other words, if any asset or security is not going to give you what you want, and then psychologically you just want to place that trade because you are tired of waiting for opportunity, it's better you increase your patience and find another thing to do with your time and wait for the signal that will give you the right utility. The right utility is that when you see such signal, you are confident enough that even if you risk your lifetime saving, even if you risk your lifetime inheritance, you will get it 10 times, 5 times, 3 times more. Like you get it multiple times. Like you are not going to blow the account. Okay, that is what we call utility. That is high utility. You need to get to that level. Why should you be trading different assets? Because you are confused. You are not sure if this one will be profitable, and then this one, you are not sure if this one will be profitable or this one. That is not how to trade. Okay, now let's continue. So there is a general formula for. Okay, assume that okay, let me talk about this. There is a general formula here. You should. Okay, I've said it. This is a iterative formula for calculating remaining capital. It's very important. Now, I've already read about these ones. Now, we are going to compute the various losses, like that since we have three, the radius is 3. The loss and profit are binary events. So, in how many ways can we select? Like, in how many ways can we sample losses and profit from 3? From universe of trade, like from trading radius of recovery radius of 3. So if you do the combination analysis, that will be 3 ways. There are possible 3 ways to do that. So if one event happens, the other one will not happen. So let's assume during trading session 1, you make a profit. That is profit 1. If you make a profit, this is the formula to calculate the profit risk reward upon the risk. Okay. Now, if you now go further, you now know that the profit will be equal to risk reward upon the risk percentage, then upon the remaining capital, like the previous remaining capital. So when you run the calculation, you have $20. That will be your profit if you make profit, and then the loss should, like, the loss at this point will be 0. But I just assume that maybe either of them will happen, but take this loss to be 0. Okay, so we are going to change this, put 0 here. I'm sorry, we are going to put because you made profit, so there is no loss. So here you risk 0, so we put 0, and then it will be equals to 0, because you have already made the profit. You cannot lose, you cannot profit and at the same time lose. Okay, so I have this, so this should be 0. Okay, now for n equals to 2, in the event of loss, profit 2 will be 0. Okay, since it is a loss, and then loss 2 will be y% upon the remaining capital. So this is where you need to understand what I mean by remaining capital. Remaining capital should be what you are seeing before you place that trade. Okay, so the remaining capital is $120 because during trading session 1 you made profit, so the remaining capital is $120. And someone will be asking how, since there is, for here there is subtraction, since there is subtraction here, how come the remaining capital is increasing? See, the risk, the remaining capital, if you are the remaining capital is also equal to, I'm not going to write this down, but I will say it is also equals to the current equity plus your profit, your total profit, or your total loss, or your net profit. Let's call it net profit. It should be net profit. When you place a trade, you either lose or you profit. Then if you add the net profit, which is the loss, total loss plus total profit, if you add it to your current equity, that will also be your remaining capital. But if the net profit is positive, then it will increase, like there will be a capital growth. But if the net profit is negative, there will be a depreciation. That means you are losing. That's why we are appreciating. So we have $120. Now, so we have loss 2, which is $12. Now S becomes 120. That is the remaining capital. Now this is where you should have been paying attention, because here we are not using any formula, we are just doing this numerically where you can understand it. So S becomes $120 minus 12, which is $108. Still appreciating because we started with $100 equity. Now for N equals to 3, in the event of loss, profit 3 will be 0 because there is loss, and then loss 3 will be the remaining capital upon the risk percentage, which is $10.80. Net profit is equals to total profit plus total losses. Profit 1 minus loss 1 plus profit 2 minus loss 2 minus loss 3 plus profit 3. Now every loss is negative and every profit is positive, so when you add them, you will get your net profit. A net profit does not mean it will always be a real profit. Most times it could be a loss when it is negative, and then if it is positive, then it will be a profit, and it means capital appreciation or growth. In other words, we are losing by $12.8. If we win the 4th trading session, we will make profit of $2. It will make profit of 2 upon risk. Because our risk reward is 1:2. So when you know your risk, which will now be the starting capital plus overall net profit. So the net profit is a negative number, so it will be $100 minus 12.8. Then you operate it on 10%, and then on 2, you will now have $17.60. Now this net profit is positive. It shows capital growth or appreciation, and it shows that you have recovered all your losses. Because if you now want to calculate the current, like the the net equity or the net equity. Most of these things I'm saying, I didn't write it down, so that means you should be writing it down. So if you want to calculate the net equity, it should be equal to the starting equity plus net profit. So because the net profit is a positive number, if you add this to the starting equity, which is $100, we will have $117.6. Despite we have been losing, we have some stream of losses, we have some some series of losses, we still come back to our equity, like our starting equity, and we still grow it by some percentage. So our net profit is $5.20. That is time growth or appreciation. So percentage net profit is net profit over starting capital or equity upon 100. That is 5.2%. Okay. Now, if you maintain a net profit that is within a fixed range over a long period of time, then the mean value of this range becomes your statistical age. A big positive statistical age means fast growth, as it means slow growth or fast depreciation. Note, all losses are negative while all profits are positive. So conclusion, there is a high probability of maintaining a positive sloping profit curve under WFS risk criteria discussed here. Okay, so what is trying to tell you that you can be losing, your psychology should be balanced. When you see losses, don't panic, accept it. Then when you see profit, accept it. When you place a trade, allow that trade to play. Make sure you place a trade with high utility, so that you will not place trade and you feel like you want to place another trade, or like you want to add another asset or security because you are not sure. We are complicating your risk. You are increasing your risk. Okay, there is power in the word, in that 100% as a word. When you risk 100%, it doesn't care whether it is $1 or $20 million or whatever. If you can risk 100% of $1, definitely you will risk 100% of $1 million. So before you place a trade, try to get the best signal. Don't place trade anyhow. Try to get the best signal. That is the only way you can succeed. Okay. Now, net profit as a function of trading session is equals to ROI percent upon sum of remaining capital subscript n-1 minus percentage risk remaining capital subscript n-1 bracket close. This is a general iterative formula you can use. For loss event, set R to 1. If in the event of a loss, then R will be equals to 1. The small r will be 1. For profit event, set R equals to R greater than 1. Now, example is when we have 1:2 plus the R is equals to 2 when there is a profit. So that's how you are going to use this formula. But if there is a loss, then the R is equals to 1. From profit net, for net profit function of n, like it depends on the discrete trading sessions. Okay, one can draw the net profit curve and equity growth curve. Now, the net profit curve is different from equity growth curve. The net profit curve will look like something like this. Okay, it will look like, this is the net profit as is PNT of n. Okay, and then this is time. Let's don't mind this. This is the origin. This is the origin where the two axes meet, and then this is the n. That is the discrete trading sessions. And then this side is positive, this side is negative. Okay, now time is, the n is positive. Now you can see that the profit curve can go like this, can be going like this, meaning that sometimes you have negative because the values here are negative. Sometimes you have negative, sometimes you have positive. But if you know what you are doing and your risk reward is good, your equity curve is not going to be sinusoidal like this. Like, it will not have a negative cycle. It will not, your equity, if your equity goes negative, it means you have blown the account and you are owing the broker. That's what it means. So your equity, even if it will have high values and low values, those low values should not be a negative value. Okay, it shouldn't even approach zero. So your equity curve can be like this. It could be like this, like that. Then if you draw line of best fit, it will point upward infinitely. That is how that shows that you are progressing. Okay. Right now I'm going to show you the major thing is this 3D stuff. Like, if you were to run analysis, how are you going to run analysis as a 3D trader? So that is the question. So I'm going to go to MT5 to start doing something. Okay, now this is USD CAD, United States dollar, Canadian dollars. Okay, let's assume you want to get a signal from this asset. All you need to do is to do your technical analysis, which is the first element of 3D trading. When you are done with your technical analysis, you are not going to take a trade. Even if it is telling you to take a trade, you are not going to take a trade. Let's assume that your technical is telling you to buy at this price. Okay, you want to buy at this price. Okay, don't buy. You are not going to buy on this price until you go to the indicator analysis, until you have performed your indicator analysis. Okay, you know, some people don't understand that indicator is also important in trading, because even though it gives fake signal, that's why I say you should not use it to get the signal. It gives fake signal, yes, but it also help you to avoid taking wrong signal from price action, because most time price action will tell you signal, but when you apply those signal, it will still lose. But with help of indicator, you will filter price action error signals. There are error signals that come from price action. You'll be able to filter them out and destroy them, like avoid them, and then make use of the one that the indicator and the price action. Like when the indicator is saying positive about the signal and the price action is also saying the same thing, like when the indicator is positive and price action is positive, that is when you know that that signal is going to hold. Okay, so let me go to indicator and show you what I mean. So this is set of indicators. Okay, this indicator is called RF215. If you want to get this indicator, you have to purchase it because it's premium. So let's go back to USD CAD. Let's go back to USD. Now this is USD CAD. Now these moving averages have crossed, and then parabolic side, price have gone beyond parabolic side. The upper parabolic side, price has broken it. Now when price are okay, you also look at this second indicator window, whereby the signal line is pointing up and the magnitude lines are on the positive or the upper like the upper part of the oscillator. Okay, the positive part. Now these things are showing that buyers are in control. Okay, That is what I mean by strong signal. It helps you to that is what I mean by signal from indicators. This information from indicator is not what will give you the entry, but at least it will help you to have confidence that the signal from price action will hold. Okay, so the next thing we are now going to discuss is risk management analysis. We have mentioned the 2 dimensions. Now if we add risk management, it becomes 3 dimensions. Now when you want to run your risk management, you have to use some lower time frame like M5, M15, M30, depending on the one that will give you what you want. But I prefer M15/M30 or H1. I prefer that way, depending on market condition. Okay, so you see that in the daily time frame, the buy signal actually happen somewhere here. So if I go to 15 minutes time frame, okay, see the 2 lines. Assuming that as I'm coming here, price left this point and go up here. You know that when you take the buy here, you are buying at a high price within this area, because there are low prices, which are these ones that you should have bought. So when price hit here and you buy, then you know that your stop loss should be away from your entry, as your should be below your entry. So your stop loss pip will increase. This is around more than 31 pip. It will increase. But if you enter somewhere here at the right entry, you have a lower stop loss pip, maybe around 8 pips. Okay, with this low stop loss pip, we are targeting over, this is 115 pips. If you go to higher time frame, you will know where you are targeting. Basically, you are targeting this key level or these key levels. So when you have 115 pips, that means your risk reward is more than 1:10, because you are risking 8 pips. Okay, so I'll be ending this video. Make sure you keep subscribing and keep learning. Join our VIP groups to grow your money, or even enroll for our courses to get more ideas so that you can trade on your own. Thank you and bye for now.